We've got an earnings alert on United Airlines, the stock jumping as much as 5% off those highs right now in the after hours after posting top and bottom line beats. It's, as we mentioned, well off the highs. It's up 1.4%. CEO Scott Kirby sitting down exclusively with our very own Phil LeBeau to discuss the results. Phil.
Thank you, Melissa. Scott, better than expected on the top and the bottom line, as Melissa indicated, much better than expected on the bottom line. And I think it has some people questioning, what is it that Wall Street is not appreciating? Because you're not alone in saying it was a great fourth quarter.
Well, I think there's really has been structural changes in the airline industry as we're coming out of COVID. One, demand actually is turning out to be higher than it was before because of hybrid work and making many more weekends possible to travel for holidays. But the bigger one is the structural change for supply. And there are constraints outside of the industry's control, whether it's hiring pilots, FAA, OEMs, aircraft deliveries, that are just limiting the growth in capacity. And what you see as a result of that is a really strong revenue environment.
The outlook for 2023, the first quarter strong, better than expected in terms of your guidance. But your full year, basically way better than the street's expecting. $10 to $12. The street, I think, is at $6.54. If there is a recession, I don't want to be part of the group that's maybe trying to talk everybody into a recession, but if there's a recession, you're still confident that the demand is going to be there, right?
We are. I mean, and I think the street is having a hard time catching up with the momentum that's happening, and not just at United, but in aviation in general. And it goes back to just the fundamentals of supply and demand are so strong. Like, we're building into our forecast at least a slowing economy and probably a mild recession in our numbers. And we think that gets us to $10 to $12 a share this year, which is a pretty amazing place to be, back to where we were pre-pandemic, even in a weakening economy. But it really it speaks to the structural changes that have happened, particularly with supply constraints in the industry. And the street just hasn't caught up to it yet.
And let's talk about that a little bit, because I think some people sit there and they want to look at the airline stocks and the airlines and think that they're operating the same as they were before the pandemic. But things have changed. There's just not the amount of capacity that used to be out there. And that constraint gives you great pricing right now, right?
Well, there are huge constraints on the industry to grow. Pilots are one of the big ones. The industry, just the big four this year, are planning to hire 8,000 pilots. The traditional number of pilots get produced are 6,000 to 7,000, and that's before you add everyone else into that mix. Pilots. We've seen in spades the last few weeks the operational challenges, whether it's the FAA or storms, what it can do to airlines over the holidays, what it did with the NOTAM issue last week. Today there's a storm in Denver, and there's a couple of the airlines there that canceled 10%. One of them canceled 10% of their flights. There are structural challenges that the system is really at peak capacity.
The FAA issue, I want to ask you about it from this standpoint. Everybody agrees that there needs to be better investment and the application of these funds. But it seems like we're in this method of, or this mode of, we talk about this every so often, and yet we're back in the same position where something goes wrong where it should have been better funded. Are you optimistic it changes this time around?
Well, I'm hopeful that it will change. And look, the truth is, the FAA's budget is lower today in real terms than it was 2 decades ago. There are fewer air traffic controllers today than there were 30 years ago. And the FAA's been asked to do space, drones, massive resources for certification programs for aircraft. And because of that, they've had to rob Peter to pay Paul.
Is Florida a good example of that?
Everywhere is. I mean, it's not just Florida. I mean, Florida gets in the news a lot, but everywhere is. And look, they did some amazing things over the holidays. I mean, I can tell you some stories of things that people in the FAA did for the Newark Tower, the Denver Tower, where water main breaks and evacuated other facilities. But they just don't have enough resources. I mean, it's just really simple. It's really straightforward. And we've got to get it if we're going to continue to have a world-class aviation
How much time will you spend in D.C. or with legislators in Washington saying we need to do better?
Well, I've been on the track saying this for the last year.
Right.
So, and I spend a lot of time in D.C. I'm probably there twice a month. And I'm telling everyone this. And look, this isn't a partisan issue. This isn't a Democrat. This isn't Republican.
It's a funding.
This is infrastructure. This is infrastructure for the country. And it's one of the biggest paybacks we could have. Because if we do this, like reducing delays, cancellations, all the downline implications that has for the economy, this is one of the easiest paybacks out there.
Scott, I believe Melissa has a question for you. Melissa, go ahead.
Yeah, Scott, there are a few CEOs who will raise guidance to the magnitude that you have tonight without being very, very confident in the outlook. So I'm wondering how investors should look at that 50 cents to $1. What are the key drivers there? Is it things that have improved, like Europe looks a little better than we thought it might be a couple months ago, the dollar backing off, your increased confidence that the recession here in the U.S. will, in fact, be mild? How can we think about this?
Well, it's really mostly it's a strong demand environment, and we look out at it, and we have really good insight, particularly for this quarter. What's going to happen? We have reasonably good insight actually for the second quarter and beyond. And what we can see, is really strong demand patterns, especially in the second half of the month. The first half of the quarter is not quite as strong. That's mostly because this new travel patterns that come from hybrid work. Are less strong, between or around Thanksgiving and Christmas, where people do their traveling on the big holidays. But we're just looking at the data for what the revenue environment is, and it's just really strong.
So 50, which is the bottom end of your new guidance, that's basically the mild recession. So that's your worst case scenario. I don't mean to hammer this home, but I mean, if things turn a little worse, is there a scenario where 25 becomes your old guidance becomes the guidance, or is that just, in your mind, just really out of the question? I'm just wondering how confident you are in terms of your forecasting, and also how confident you are that demand will actually hold up, even if unemployment reaches closer to 5%.
Well, this is our base case scenario. And by the way, I never say worst case scenario. I've always said to people, there's always something worse that can happen. COVID proved that. You should never say worst case scenario, because there's always something that can be worse. But we have a lot of confidence in this forecast. Could something happen? Yeah, we've seen it in aviation. You could have an exogenous shock that causes something to happen. So it's not 100%. But it's our base case, and we have a lot of room on that. And particularly with the economy, what typically happens if the revenue environment got worse because of a deeper recession, for example, usually we'll make up a lot of that on the fuel side. So fuel prices go down along with a weakening economy. So there's a natural hedge for us between the revenue and the fuel environment.
Let me ask you about China from this perspective. Now that they are opening up, if you will, there are a lot of people who are wondering how quickly demand, especially from the U.S. over to China, which so much of that was corporate driven, not entirely, but a lot of it was. How quickly do you expect that to come back?
We don't know. It's a TBD to see what's going to happen. There's still rules about, going back and forth. I think for now we see strength in demand for what we call VFR, visiting family and relatives. But the corporate is holding off a little for right now. And our guess is that's probably true for at least the next 90 days or so. Let things shake out, see what the status quo, what the standard is going to be. And then there's going to be the additional question about adding flights, and particularly Russian overflight. Most of the flights to China need to fly over Russia to get there, and because of the Ukraine war, can't fly over Russia. So my guess is the number of flights, even when demand does start to come back, it's mostly going to be a West Coast to China set of flights because you can't get there.
On the other side, transatlantic, you guys are expanding aggressively as we head towards the summer. All systems go in terms of what you're seeing with demand?
Yeah, this is turning out just like we thought it would. 2.5 years ago, we decided to keep all of our airplanes. We negotiated a deal with our pilots union, only airline in the world, to keep everyone in position and in their seats for the recovery. And because of that, we're going to grow across the Atlantic 36% this summer. We think it's going to be great and gangbusters. The total industry is essentially going to be flat because other airlines cut back on their aircraft and downgraded pilots, and that takes years to reverse those decisions. So it's an environment where there's a really strong demand dynamic and a big constraint on supply.
Last question, pilot contract. How optimistic are you that first half of the year or maybe by third quarter things get locked in?
Yeah, I'm very optimistic. In fact, our pilots union has had some leadership turnover, and they've been doing recall elections, and they expect to actually have their union leader elected later this month. And they've told us they'll be back at the table with us starting about February 7th. Because of that, and because of the Delta deal, I think we all kind of know we're pretty close in the same ballpark. So it ought to be done pretty quickly once we're back at the table. But they've had to wait until they get their leadership structure in place to get back to the table.
Scott Kirby, CEO of United Airlines, on a day, guys, where they beat on the top and the bottom line. But it's the guidance. That's what people are going to be talking about, particularly not just the first quarter, Melissa, but when you look at the full year, $10 to $12. And as I mentioned, going into today, they were at $6.54. The street was at $6.54, so well above what Wall Street analysts were expecting. Send it back to you.
All right. Thank you so much, Phil. Thanks, Scott, to you as well. Tim, we got to go to you. I mean,
the A in the lags trade. So first of all, this whole thing about Wall Street didn't recognize it. I mean, United's up 40% in 9 trading sessions. So because they didn't, I think a lot of this guide was understood. We've heard it from every other airline. So United's doing a great job. Scott Kirby's doing a great job. And if you listen to the thing that he said, that is, again, the airlines have a history of not being efficient, especially when times get good. That's the worst thing that happens to them. So when I hear someone say, and I'm not implying that this is what United's going to do, these were constraints outside of our control that have led us to cut capacity. When they have the ability to control, what are they going to do? Right now, this is an optimal pricing environment. Airlines should go a lot higher. They're trading at significant discounts to where they were pre-COVID.
So if you look at a chart in United specifically, since Scott was on, into 2020, that was lower left, upper right. We obviously know what happened. This, by the way, was, I think, a $95 stock in the fall of 2019. Just putting it out there, number one. I mentioned 2019 because the comps now are against that. PRASM. Passenger
revenue for available seat miles. Let's do this.
It's up 24.6%, not versus last year, versus 2019. Average fuel price is down 12.5% from 19. So you start to do the math and say, wait a second, this stock can still go higher from here. Now, I don't know if it gets back to 95 tomorrow, but $60 if you go back and look. That's where we broke down from in March of last year, and that's where the stock should trade up to.
I tried to come up with an acronym that could include E for Expedia, because all these things that you guys talk about, and you guys have been on this airline trade, I really think Expedia is just way too cheap. If you think that demand for in and around this space is coming back.
What was your acronym again?
TSLQ.
TSLQ.
Oh, you really made it tough.
Yeah.
All
right, but here's the thing. But here's the thing. Earnings are supposed to rebound. They're supposed to be up 30% year over year on 9% sales growth. This is a high gross margin business here, trading 11.5 times next year. I mean, to me, this seems really cheap.